Hi, this is Marie from Legacy Publishing. In today's video, we are going to update this year's best profit opportunity. Chuck, can you explain to our viewers your current outlook for Apple stock?
Marie, in a previous video, we discussed a little noticed accounting change that allows Apple to report revenues from iPhone sales in the current quarter instead of amortizing these sales over 8 quarters. Now, this accounting change will increase Apple sales and earnings, and analysts expect Apple to earn $12 this year. Apple stock is currently trading at $223, and $12 in earnings translates to about an 18.5 PE ratio, which is considerably lower than the recent average PE ratio of 32. So if Apple earns $12 this year and trades at its recent historical PE ratio of 32, the price of Apple stock will rise from its current price of $223 to about $384 this year. Now keep in mind this price increase from $223 to $384 doesn't require great earnings increases for Apple. It only reflects the average recent historical PE of 32 for the stock. And also, with the release of the new Apple iPod, which is expected to be shipped in April, the $12 earnings estimate could be conservative. Remember, in 2007, Apple released the iPhone, and the stock traded at a 39 PE ratio. If that performance is repeated this year with the release of the iPad, Apple has a lot of upside potential.
Chuck, Apple stock has been increasing in price. Do you recommend purchasing the stock at these higher levels?
Marie, yes. With a current PE ratio of 21, Apple still has plenty of upside potential if it trades up to its recent historical PE of 32. Now, the question is, where do you jump in with a new position after the run-up Apple has already made? I like to use the Keltner channels to help time my entry point. We can see from this Apple price chart that has the Keltner channels that normally when the price of Apple stock closes above the upper channel, which indicates the stock is overbought, the stock usually retraces back to the middle channel, which is the dotted line, and then it starts another leg up. So the retracement to the middle channel is normally a good entry point for new long positions. Now, the Apple stock price is currently above the upper Keltner channel. So if Apple drops down to the middle channel, which is currently at around the 214 level, it would be a good entry point for new long positions.
Chuck, what type of trade do you recommend for initiating new positions in Apple?
Marie, I prefer to initiate in-the-money option spreads with lots of downside protection. In-the-money option spreads can help you maintain your position through volatile price swings that would normally stop you out of a directional option trade. In-the-money option spreads act more like a market-neutral spread that can profit if a stock increases in price, remains flat, or decreases in price. This brokerage confirmation shows that I purchased the Apple January 150 strike call at 62.44, and I sold the January 170 calls at 47.99. Apple stock is currently trading at 223, so the purchase of the 150 call and the sale of the 170 call created an in-the-money option spread with lots of downside protection, as we'll see here in a minute. This call option spread analysis displays the profit potential for this in-the-money option spread for various price changes for Apple stock at option expiration, from a 10% increase in price to a 20% decrease in price. Now we can see from the spread analysis that if Apple stock price increases at option expiration, a 38% return will be realized. A flat stock price of $223 would also result in a 38% return, and a 20% stock price decrease to $178.40 would also result in a 38% return. So this in-the-money spread has the potential to profit if Apple stock increases in price, remains flat, or decreases 20%, making this the ideal trade for today's volatile markets. Now, I found that this type of downside protection can help prevent the premature stop out of your trade during volatile price moves. Now, the cost of this in-the-money spread is 1445 points, or $1,445. I normally place a protective stop to close a spread if the price of the long call declines to the cost of the spread. The January 150 strike call is currently trading at 78.85. So in this example, if the price of the 150 strike call declines from the current price of 78.85 to the cost of the spread, which is 1445, then I would close the spread. The price of the 150 strike call would have to drop about 81% before this stop would be elected. So this spread trade has the potential to deliver a substantial 38% return and has a high probability of profiting during volatile price moves, as I would not be forced to close the trade unless the 150 strike call declines more than 81%, making this in-the-money spread ideal for volatile markets. So to summarize, the recent accounting rule change has lowered the PE ratio for Apple stock this year, providing investors with this year's best profit opportunity. Entering in-the-money option spreads for Apple can provide good returns with low risk.
Well, Chuck, it appears that Apple has a great future, and I hope our viewers were able to gain some valuable insights into initiating new long positions in Apple using Keltner channels to help time a good entry point. I want to thank everyone for viewing, and I am looking forward to our next presentation.